Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me for this segment, we have Nick Gaskell, Portfolio Manager with Eaton, Vance, Water Oak, to discuss interest rates, the flood, inflation, and we will also talk about earnings. Nick, it's great to have you with us. Welcome to Trade Talks.
Hi, Jill. Thanks for having me.
You got it. And let's kick it off with third quarter earnings because they've been much better than expected. What did you take away so far from the quarter, and what are your thoughts heading into the next?
Yeah, so ahead of the third quarter, there was a handful of profit warnings from early reporters, and I think that put market participants on edge. What we saw was really resilient margins. So I think my two high-level takeaways are demand remains strong, margins were more resilient than expected, earnings grew 39% in the third quarter, and in the fourth quarter, we're expecting potentially better than feared earnings again as margins have proved resilient. So they're a little below where they were in Q2, all-time highs, but they've been able to weather the storm.
And what's interesting, Nick, is we all know that inflation is running hot here, and we've seen record mentions of supply chain issues from corporates. Are there any signs of relief on the horizon? Because to your point, you were saying that margins are able to absorb this to a certain point.
I think there are some green shoots of optimism. So the Baltic Dry Index is now at a 5-month low. I saw a headline yesterday that containers sitting at the port of Los Angeles have declined by 25% month over month. Inventories have rebounded off historically low levels. So I think price pressures could persist, but for us, the best leading indicator of lower inflation is lower growth. So to the extent that growth in earnings and GDP slows next year, we could see inflation tick down as well.
So then what can help companies weather the inflationary environment?
Simplistically, businesses with good fundamentals, so high and stable gross margins, the luxury of pricing power, businesses and industries that are growing. Growth can help offset some of these pressures, and clean balance sheets. So we're looking for companies that aren't going to have to refinance their debt in the future if rates are potentially higher.
Right.
And lastly, we would just avoid companies where a significant part of their input costs are labor, because that may be stickier than some of these other elements.
Right, and that's a great point that you bring up, and I want to wrap up here talking about Fed policy. We've covered inflation. We know that the labor situation is still, kind of unforeseen, right? And of course, this is going to impact their policy and what will be happening with the speed of tapering and interest rates. So when you think about that all underneath the Fed's policy umbrella, what do you think it's going to look like moving forward as we get into 2022?
Yeah, I think tightening Fed policy is going to be a headwind, particularly for valuation multiples. Investors today expect 2 hikes in 2022, but if inflation were to cool down, then the Fed could have the luxury of being patient. So there might be a hesitancy to tighten if growth does indeed slow. So policy could remain pretty accommodative next year. Ultimately, we believe stocks will follow earnings next year. Earnings growth is expected to be high single digits. That could be offset by some modest multiple compression. And then lastly, we're just, want to be mindful that it's a midterm election year, and stocks tend to trade sideways, for the first 10 months of the year.
All right. Well, and Nick, one more question actually for you. I think this is the first time that the Fed nominee is really kind of caught in these headwinds of what's happening on the political side, and also dealing with an economy that is overheating and dealing with inflation. It seems as if this particular nomination really has people watching.
Absolutely. I think it's certainly a tough spot to be in. And I think, the Fed wants to kind of stay out of the political turmoil. So that alone may be a good enough reason to hold off on tightening policy until after the midterm elections.
All right, Nick, we appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.